Hey, what's up, y'all? Let's talk about what happened in the market today. So, we got CPI data, we got Trump, we got the Federal Reserve and interest rates. We'll talk about that. We'll look at some stocks here at the end and also what to look forward to as things continue to unfold. That way, we're all updated and on the same page. And if you like these type of videos, just stay tuned because I got more coming. So, this one was huge. S&P 500 turns positive on the year. So remember when we had Liberation Day, Trump announced tariffs, market went boom. Literally in a straight line down, boom. And everybody was uncertain about what could come out of that, and it really spooked the market. So now we see things are in a better place right now as far as positivity in the markets, and we see that the S&P 500 turns positive on the year. So today we got a huge data set. We got a data set that measures inflation. So this is the consumer price index. CPI is usually what people call it. And right here, we'll just read it together. CPI is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. All right, now let's get into this and talk about it. So a couple things before we get into it. This data was compiled before most of Trump's tariffs were increased. So just consider this. And what we see from this report being released is that April's annual inflation cooled to 2.3%, which is the lowest since February of 2021. And this is below what analysts expected because they were expecting something closer to 2.4%. So we're just zero point 0.1 or 10 basis points below analysts' expectations. Prices rose at 0.2%, down from the expectations of 0.3 month over month. And shelter, which came in at 0.3%, accounted for more than half of all of the items' monthly increase. Now, this is interesting because we see that inflation, the Fed is really winning the fight on inflation. But there's another fight that the Fed's taking in on. Now, what we see right here is a chart that I found, and you can look up this article right here. It's by Joy Wiltermuth. Hopefully I'm saying that right. Sorry, Joy, if I'm not correct. Hold up. Temporary nature of tariff deals makes a Fed rate cut difficult in June, economists say. And we got this chart right here, and it says the Fed could cut, yet remain restrictive. And I thought this chart was interesting because it really compares this CPI data that just got released today and how it's performed over time, along with the federal funds rate, which is what the Federal Reserve oversees and adjusts based on what the economic data supports. Now, they've been fighting inflation down. They've wanted it closer to their 2% target. So they've wanted inflation down to their 2% target, and really not so CPI is what they're focused on. They're more focused on PCE, personal consumption expenditures, but CPI is also another measure of inflation. Now, what we see is that CPI has dramatically dropped, and it seems that the Fed's right on track with what they want. Now, what we also see is that the Fed hasn't really cut too much. We've been doing a lot of wait and see policy. So we're aware of that. And the Fed came out recently and they didn't lower rates. They just chose to stay set and continue watching the data as it comes in. And they've also announced that they're aware that they're usually late to the party, and that will likely be the case here. Now, this is interesting because this is the other end of the fight. So the Fed's fighting inflation, but they're getting double teamed because they got another fight that they're fighting at the same time, and that is President Donald Trump. So Donald Trump made a Truth Social post today, and it reads, "No inflation and prices of gasoline, energy, groceries, and practically everything else are down. The Fed must lower the rate, like Europe and China have done. What is wrong with too late, pal?" He's attacking them again. "Not fair to America, which is ready to blossom. Just let it all happen. It will be a beautiful thing." So here's Trump really pressuring the Fed to cut rates again. And who knows if that's a good thing or a bad thing. This could be kind of scapegoatism here because I was just talking to somebody and we were talking about how before tariffs were ever an issue, interest rates were the issue. Things being expensive, goods and services were expensive, and wages, people wanting higher wages over time. So those two things causing increases in prices of goods and services. And then on top of that, who has cash these days? So a lot of people got to borrow, and interest rates are high. So you got high prices, and then you got high borrowing costs. So everything's just high up in the air. And Donald Trump really wants this inflation to go away, because even if we cut rates or tariff rates to zero, interest rates are still high. And what we see is that inflation is trending down and eventually will hit the Fed's target. Now, who knows when that will happen? Anything could happen. So what we see is Donald Trump is continuing to attack the Fed. And the CPI data really gives Fed officials little reason to change from their wait and see policy, because if inflation's trending down, we're getting closer to the Fed's target. We're not quite there yet. So why would they really need to cut prematurely and then face the risk of undoing all of the work that they've done? Because this has been a long fight. I believe we started raising rates back in 2022, I believe. We could verify that real quick. So we could look up Fed funds rate, and then let's put the name Fred. Let's just see. Let's check it out together. All right. So this is from the St. Louis Fed, and it'll give us the data. And it looks like, yep. So about February or February, yeah, hold on. So, yep, February is when we started increasing, and we stopped increasing the federal funds rate in August of 2023. And man, it's really just, it's been quite the high. But this really controls the front of the curve. This doesn't really impact longer term rates. So the federal funds rate is it really impacts overnight borrowing costs and things closer to short-term rates like credit cards, but not necessarily 30-year mortgages, which would be followed by more so the market's expectations of what inflation will do over time. And we'll talk about this more in the upcoming videos I release, but just think about the timeline. People are in houses, right? They're in homes 7 to 10 years, and between that timeline, one of three things happens. One, they'll pay the home completely off. They'll do that a couple different ways. They'll either sell the home, or they'll refinance, or I guess there's really just two ways. They'll refinance, or they'll sell the home, or I guess pay it off. And that leads lenders, if it's in a 7 to 10 year window, all right, I'm going to check Joel's credit. Hopefully he keeps a job. So something that's kind of risky. So something they're going to compare it to is the risk-free rate of just lending the same money to the government for 10 years. And that, in this case, would be let's go into cnbc.com. And then let's do this together. If my computer wants to keep up with me, let's type US 10, and then we'll click this. So this is the rate at which they could lend the money to the government, who could print money. And what are the odds the US government doesn't pay you back, right? So this is pretty much considered risk-free versus lending to Joel, who could lose his job or just stop paying us. There's a little bit more risk, so there's going to be a premium above that. So a lot of lenders compare the 10-year treasury yield to that. Now, I digress. Back to the CPI. This really doesn't support a Fed cut just yet, but with Trump wanting the Fed to cut rates, the tariffs make the job for the Fed hard, because they could lead to higher unemployment and inflation, which leads me to wonder. Let's go to Google real quick. Oh, why is my caps on? Google, and let's look up stagflation definition. And what we see is stagflation is a term used to describe a situation where the economy experiences both high inflation and slow economic growth, often accompanied by high unemployment. So it's really a tough time right now, and especially for the Fed. They're fighting both, imagine them with like a black eye, and they're tired. And they've really kind of been beating up inflation, but it's been a long fight. We've been doing this for like 3.5 hours, but inflation's finally given up, and it's looking hopeful. But then you got like Donald Trump fresh off the Gatorade coming in ready to fight. And they're kind of like, he's kind of trying to beat the Fed up too. and really wanting them to cut rates. So yeah, these tariffs make the Fed's job hard because they could lead to higher unemployment and higher inflation, which they have been fighting. So we don't know how these tariffs will ultimately impact inflation in the longer term, because anything could change. This man's a wild card. But according to the CME Fed Watch tool, which in 35 days, 17 hours, 33 minutes, and 28 seconds on June 18th's FOMC interest rate decision, it's a 91.8% probability that the Fed just stays completely the same. They aren't really expected to cut rates until after September. So September 17th, we only got a 50% chance that they cut rates by 25 basis points or a quarter percent from where they are right now. And we're expecting by December, just curious, super blurry the further we get out, and this changes with how economic data comes out. You got economic data releases coming out pretty much every day, and Fed speakers and earnings reports from large companies giving details about the consumer and the state of the economy. So all these numbers continuously change, but 37.4% is the highest prediction right now, and that will lead us to 3.75 to 4%. So that is 2 cuts this year of each 25 basis points. So 0.5% from where we're at is where we're expecting to end off. And yeah, it just kind of leads back to this, because if what's gonna happen, honestly, and nobody really knows, because these, especially with China and the US and this possible trade war, if things get worse and tariffs are increased, who knows if it's very unlikely they go back to the levels they were of the 125% and the 145%. Those numbers are kind of unrealistic and unlikely, but T-Man's a wild card, so we don't know where this man could take us. And these tariffs are inflation inducing, so everybody's really watching the tariffs. That's like the new kid on the block everybody's interested in. Forget the Fed, they're old news. So everybody's gonna keep watching this. And as everything's really been cool, as far as the China trade announcement that came out over this weekend, we've seen quite the jump in stocks. And if you watched my video yesterday, or maybe the day before yesterday, I put this line right here on the Qs for 510. And I think it's maybe a strong line. Who knows if we'll come back down to it, or if we're headed up next to the next spot on the fib that I got at 540. Who knows? All of that's up in the air. But these trade talks with China are hopeful. There's light at the end of the tunnel. And there's been some talk about what are some contrarian plays about or these contrarian trades would be big winners from a no landing scenario, Bank of America says. And it's pretty much saying that the US stocks, emerging markets, small caps, and the energy market would all perform well under this no landing scenario. And assuming the US economy keeps accelerating. And then I got some percentages from a fund manager survey that was showed here on this article. So 6% expected a no landing, which is when the economy just continues growing despite efforts of slowing the economy by the Fed, right? So the Fed's really orchestrating the plane, and they're imagine the landing as a recession, and they're really trying to time it just right. So no landing is we never land, we never touch the recession at all, and we just keep on going up. Like, we got plenty of fuel in the tank, we're good. 61% see a soft landing happening, and a soft landing is more so, imagine a slowdown in the economy, but we don't really, like, it's not like a you know, when the plane lands and it's like it's not one of those. So we never actually go into the recession. That's avoided. And then 26% see or predict a hard landing happening, and that would be a recession. So investors are expecting the US economy to contract in 2025, fell to a net figure of just 1% versus 42% during the April vote, and reducing expectations of the Fed easing and lend greater support to the dollar. Now, I also thought this was interesting because in this article, the bulls are back in town. Goldman and this Wall Street optimist are lifting their S&P targets on tariff relief. And what we see in this is that, where's it at? Right here. In a separate note, Chief Economist Jan Hadzius cut the bank's recession odds to 35% from 45%. So everything's starting to get a little bit better. Yeah, it's less chance of a recession. There's still some chance. I like how George Gammon puts it. There aren't certainties, there are only probabilities, and they think the probability of the US going into a recession are a little bit lower. But remember, tariffs are the shiny shoes that just came out, and everybody's like, oh, like look at those. Everybody's eyes are on tariffs. Now, what everybody's eyes were on was the Fed. The Fed and inflation. So I just wonder what happens if tariffs completely went away, and what would come out of everybody eyeing inflation. Inflation and the federal funds effective rate again, all over again, and how that would really coincide with everything. Because we just talked about it. Costs are high on one hand, so everybody wants a raise, and like companies aren't gonna like make less money, right? They're just gonna pass that on to consumers. So yeah, you want a job? You want a job and you want paid more. Yeah, I'll pay you more. We're just gonna increase the prices of what we sell, goods and services wise. So then costs go up, and then it's like, all right, well, on the other hand, we could just borrow the money to pay for it, but interest rates are high. So it just goes back to that, the step one again, in my opinion. So I believe this balancing fight between the Fed and inflation and this three-leg stool, because I wish there was included in this tariffs, because then we'd be able to see more to the picture right now. And there's just a lot going on. So we're going to keep on watching this. Who knows what could happen out of it? Right now, it seems that the Fed is good with not cutting at the next meeting, unless, we get some bad news, some black swan event comes out, something terrible comes out. But everybody's expecting Q2 earnings for companies to do really well because everybody was front loading the tariffs, so they were spending more. And spending more made the job data look better because companies need employees to like service the goods and services as they need, right? So everything's looking bullish, right? So everybody's saying that if things do start getting bad, that could be like June, July, August, maybe even September before we actually get there. And that's interesting because everybody, according to the CME Fed Watch tool, aren't expecting the first cut until September. Interesting stuff, y'all. Interesting stuff. So I'm going to keep watching all of this. We'll continue watching the market, and I'll keep presenting it as it comes out. So today, stock market did pretty well. Let's see what Bitcoin did today. So since yesterday, pretty good. We've seen treasuries and USD. So there was a sell-off in treasury yields gone down a little bit, which means people are buying treasuries, so there's treasury demand. And then the DXY, which is the dollar. Let's see how that did today. Oh wow, so the dollar sold off today. Interesting, due to US-China trade. And I'd be interesting to see how this performs over time, just as everything continues unraveling, let's put this on the day chart. Let's go a week. I want to see more. I want to see more of this. Shoot, let's go on like the month chart then. All right, there we go. So we're really just like right in the middle, and 1985 is when it reached its highest point. Just for funsies, let's put it on a Fibonacci retracement real quick. I'm a little bit different how I place my charts, but I like just seeing. I look for spots where it really hits a lot. See, it really doesn't hit right there, but interesting. I didn't say Siri silly. So I don't know, I digress. We'll continue watching all of this stuff, everybody. I'll keep on presenting as it comes, and I'll do my best to get better at it. But I hope you enjoyed this video. Continue looking out for more, and I hope your day is great. Y'all have a good one.